All right, welcome to our Monday edition of On the Tape. I'm Dan Nathan. I am joined, as always, by Guy Adami, and of course, and of course, EY from SoFi. That would be Liz Young. She is the head market strategist at SoFi. Liz, welcome Monday morning.
Buenos dias.
You know, it's funny, Guy. I don't know if you caught this. All weekend long, you and I are doing yeoman's work in our group chat about what we're going to talk about on the Monday pod, right? We're putting some kind of story links, that sort of thing. And Liz, at one point in this fine long weekend, I think it was Friday afternoon, basically gave us the Heisman, whatever that emoji might be, in a group chat, and basically said, hey, listen, I got friends in town. I'm going to be drinking champagne all weekend. I'll talk to you guys on Sunday night.
Yeah, I did. Sorry, not sorry.
Guy, what was your take on that? Because you went silent for a while.
First of all, I love that. I think it's fantastic. The weekends are for, what is that old commercial?
Libations.
Low and brow type of thing.
Yeah.
Remember that whole thing?
Yeah. Well, she had a great Friday. Let's just put it that way.
I had a good Friday. And you know what, Guy? I went to a birthday party on Saturday for that friend of mine who you love.
Stop it.
Amanda.
Yeah.
Yep. We had a nice
Edgy.
little...
All right, so we had a long
fiesta.
weekend. Some of us had a lot of fun. We hope you guys all enjoyed your holiday celebrations here. We got a lot to cover this week. We were out on Friday. Markets were closed for the all-important March jobs report. We're going to talk about that. Liz, you had a fire tweet out. Not really. I'm just saying that. We just retweeted it, and we thought it was hot. And then we also have a lot of economic data. We have a really important CPI print this week. We have some consumer data, and then we end the week with some important earnings from the banks here. It's going to get earnings season kicked off. And we also want to hit a couple reports that we've seen as Samsung and Taiwan Semi about some of their Q1 data. And of course, there is a pre-earnings take on Apple, or really, computer shipments across the board. But Apple's were down more than all of their competitors, down about 40%. At least that's what IDC is reporting. So we're going to hit all of that. All right, Liz, where do you want to start here with the jobs report? Because before, I'm assuming you weren't drinking mimosas at 8:30 on Friday as the March jobs report came out. What was your take? And you had, you were focused on the bond market's take on the jobs report.
Yeah, well, the markets weren't open on Friday, so it was sort of this anticlimactic report. The data itself was sort of a nothing burger, which is what I tweeted on Friday about it. It wasn't anywhere far off of expectations, didn't shock anybody. Unemployment rate actually went down a tick, but number of jobs added came in right around consensus, which honestly, I don't think the market would have had a very positive reaction to a disappointment or a beat. I think it would have been a bad reaction either way. So the best we could have hoped for market-wise was kind of a consensus report, which is largely what we got. However, what you're seeing now as we record this, which is at about 10 a.m. on Monday, the NASDAQ is down 1.2% right now. Dow is marginally up, flattish, but yields have risen. And the 2-year and the 10-year yields have risen, and rate hike expectations have gone up for May. So as we all know, the rate hike expectations and the odds have swung wildly over the last few weeks, through the whole month, really, of March and most of April so far. But here we are back to about 68 to 70% odds of a hike in May. The only reason that they would have changed that much is because of the jobs report. So it's possible that we get another hike. I am really on the side that I think they're done. I think that there's going to be stress in April that's going to convince them to either pause or just be done entirely. But the market continues to not be so sure about that.
It's pretty amazing. Again, now all the pundits are talking about bond market volatility. I saw it this morning on Squawk Box as well. Everybody's alluding to it. You look at the TLT, which is obviously one of the ways you can trade interest rates. Every time the TLT has gotten up to sort of 109.5 since December of last year, it's failed. It's happened about 2.5, 3 different times. I mentioned a half because there was a brief period in February, but every time it stalls there and TLT starts going back down, it means rates continue to go higher. So just technically against the TLT, rates going higher, I guess makes sense. But then the question, Dan, you have to ask yourself again, are higher rates a good thing? I mean, everybody seems to think lower rates are a good thing. I'm not quite certain any move in interest rates at this point is all that constructive because the bond market is still trying to figure out what the equity market seems to think they already understand.
Yeah, you've been on that for a very long time. And it's funny. I think it sounded counterintuitive to a lot of people, or talking out of both sides of your mouth. That's not something that I felt. But it's normally if there was a pundit or a market participant talking the way you were about rates, once we got, the 2-year above 5% and the 10-year, well above 4%, despite Fed funds not being, near that 5% range, you were saying from that point on, okay, if yields go up material, it's going to be really bad for the economy and really bad for the stock market. And if they go down too much, too quickly, it's also going to be the same thing. So I think to your point, stability at this point would make a lot of sense. And Liz, to your point about what it means for the Fed and their rate decision, our friend Peter Bookvar over at Bleakley Advisors in his book report this morning had a really good comment about the report. So he's basically saying Friday's payroll report should not be tilting the Fed's May decision to a rate hike, as I'm hearing many say. The survey period ended March 12th, just a few days after the SVB went down, and the ripple effect was just starting to filter through the entire banking system. Therefore, Friday's report for March should be viewed as mostly pre-SVB. And this is really, I think, the most important point. Look at things that have happened since, like the last few days of higher jobless claims than we had originally thought. Also, did you see the CNI loan data last week? Okay. And so this is really important. That's commercial and industrial loans. I mean, they're kind of falling off a cliff. Liz, talk to us a little bit about that, because again, this really speaks to the fact you can look at where Fed funds is. You can look at what the rates that are attached to it are, but the lag effect, how they work through the economy, is really the thing about what we should be most focused on, like when that recession is likely to come. Because again, it wasn't going to be like we were going to be in a recession when the 2-year yield got to 5% or Fed funds finally got above 5%. There's going to be all these knock-on effects, which are really hard to predict.
Yeah. Well, so first of all, there's a lagged effect in the jobs market too. So he's right. The survey happened right around when SVB failed, so we wouldn't expect it to come through. But you wouldn't expect it to come through 2 or 3 weeks later yet either. You have to look at things like JOLTS first, and JOLTS this month came in.
So that's the openings,
job openings. And I've long expected, as many have, that JOLTS should come down and show weakness first. Basically, companies saying, you know what, we're not going to hire that many people. So they're going to reduce the number of jobs that are open before they actually have to cut employees, which is what would show up in NFP and initial jobless claims and so on and so forth. Also, everybody keep in mind, there are warning periods in all the states. Every law is different, but there's a warning period. If you're going to lay somebody off, you can't just tell them that day. There has to be a warning period. There's sort of this transitional period. So even when stress happens, it's not as if companies go out the next day and say, okay, we're cutting, 5,000 people from the workforce, and that we're gonna get these jobless claims that show up immediately. There's a lagged effect there too, but it is starting to show up in the JOLTS data. It was one of the weakest JOLTS reports that we've had since 2020. So keep that in mind. The lagged effect on rates is absolutely starting to show up in things like commercial real estate, as we've heard about. I know we're going to talk about some of those headlines, but there were headlines, I think a couple months ago, we had some of the first big defaults that happened in commercial real estate, which ended up being kind of the canary in the coal mine. We're going to see that pick up. And this also is going to affect when we look at spreads in investment grade bonds, you look at high yield spreads, there's a lot of refinancing that's going to have to happen in the corporate space, not just real estate, over the next 12 to 24 months. It's all going to have to be refinanced at higher rates.
So Guy, before we get your take on this, there was an article in Bloomberg over the weekend. A $1.5 trillion wall of debt is looming for U.S. commercial properties. And so that's, I think, what you're speaking of, and they're going to be front end loaded. It was a great article. We'll put that in the show notes. But then there was also, to your point about the canary in the coal mine, here was an article from The Real Deal. Blackstone takes 36% loss on a Santa Ana office space. While they didn't disclose the price, it's interesting. I mean, so this is the sort of stuff we're seeing. And then obviously that Blackstone B REIT, they put up gates in October, I think it was. In November, we were kind of talking about it back then. And Blackstone's really been heavy over the last few weeks, especially since the SVB thing. So these are the next shoes to drop. And then there are some out there, Guy, who are saying, listen, this is just normal cycle stuff or whatever. Should we be paying attention to this, very close attention?
Normal cycles. If there was anything normal about our economy over the last 20 years, I would say you're right. The problem is normal cycle stuff has now been magnified by probably tenfold, given the amount of liquidity that was floating around the system for so long. So things that would have been normal in normal circumstances and sort of pedestrian and run of the mill, I think are going to be 5 to 10 times worse, given all the, and I'll use the word, leverage in the system that liquidity created. And, you mentioned Blackstone probably over a year and a half or so ago. Watch out, people. Blackstone, if housing starts to turn, the economy starts to turn, Blackstone's not going to be sort of immune from that. And that proved to be extraordinarily prescient. We had Joe Zeidel on Fast Money probably, again, a year and a half, 2 years ago, and effectively talking their book, which they should do, but you sort of called bullshit on that.
Well,
proved to be right.
Guy,
and I bring it up because Blackstone, if you think about, go back and look at the stock.
Yeah.
I mean, that was the poster child for everything is turning, coming up roses. And now when things are going the other way, to your earlier point, if they didn't have the gates up, I mean, there would have been effectively, and I'm using air quotes now, a run on the bank at Blackstone.
Yeah, and just to be clear, I think the Joe Zeidel, when he came on and he was talking about how he wasn't particularly worried about commercial real estate, I think it was about a year ago. And I think that you and I both had our kind of antennas up, and I think we said right afterwards, they're kind of talking their book a little bit, which you would expect them to do. But I think it's really important when you talk about the price action of the stock. Okay, pre-pandemic, the stock in February of 2020 was about $65, and it sold off. It got cut in half, okay, to the lows in 3 months or something like that. And again, you might have expected that given what we didn't know about the global economy, and like at the time, there was real fears of like some sort of credit contagion if we were really going to be shut down, that sort of thing. From its lows, it went from $33, okay, in late March of 2020 to highs of basically $150, okay? When the Fed, it literally topped out, Guy, on the date that the Fed basically said that they were going to start thinking about raising interest rates to battle inflation. So it got to 150. And the chart, if you just took off the axes, it looked kind of like SVB. Like it was I think you just used the term, the poster child for whatever, 15 years of zero rate interest policy, all that sort of stuff, and all the enthusiasm about what was going to happen after the pandemic. So, Liz, when we talk about some of these things and we talk about poster children, I know that you don't kind of talk about similar stocks or single stocks. This is a really great example, though. Sometimes just looking at a parabolic move in a stock or some sort of security can just tell you about irrational exuberance. Trying to pick a top on that is really hard, right? And trust me, as a trader, I know that really well, but it's one of the reasons why we track sentiment data really closely, why we look at a lot of charts. This is a lot of the stuff that we do on our market call, which you are also our co-host on Thursdays at 1 p.m. Eastern. So find it in the Risk Reversal Media YouTube site, right, Guy? And what should they do there when they get there?
Smash the shit out of the like button, and they should
subscribe.
also probably, if they haven't yet, and I don't know what they're doing. First of all, you got to follow EY on Twitter, but you also have to follow us on the YouTube channel, which you can get at your favorite podcast store. Back to you.
All right, so Liz, the point about parabolic charts, when you see that sort of behavior, it should get antennas up, correct?
Sure. And as a strategist, there are a lot of strategists who will try to call tops and bottoms, and they have year-end targets because they have to. I don't know that there really is anybody out there who loves having to do that, but I won't try to do either. However, what I do try to do is feel when things are getting a little bit toppy or when they're getting a little bit over their skis to the point where I can't make a good argument for it to continue going up. Does that mean that I'm going to miss a little bit more on the upside? Sure. But as I think I've said on here a few times, when things start to fall, it falls so fast you cannot catch it.
Yeah.
So there is no sense in waiting too long. I want to go back to something that we were talking about in the commercial real estate market and kind of the pushback of, well, this is just natural cycle stuff. And let's distinguish, because it's true, and we should try not to sound overly bearish about that, oh my gosh, something bad is happening and we're going to, make it sensational. It's true that naturally in any cycle that does happen. The difference is you have to look at what the cause of whatever the event is. Sometimes it's unique to that company. Maybe it was poorly managed. Maybe it was concentrated in a certain sector. Maybe there was something else that was going on just at the company level that's causing things to fall apart. In this case, this is caused by rising rates It's caused by the change in work habits, people not going back to offices, right? So then you have to sit back and say, those are pretty universal problems for an entire industry, and it's going to affect other companies. That's where it makes it not a normal cycle situation, and it starts to be something, I won't use the word contagious because I don't know that that's necessarily the case here, but it's a headwind that every company in that space is going to face, and that's what makes it more dire.
Yeah, and so let's talk about banks. They're going to get out of the gate here with Q1 earnings, and I think obviously this is a huge focus, just kind of the commentary more than anything else. And if you think about like the KRE, which is the regional bank index, from its highs in early February, it was right near $65. It sold off about 37% to its lows last month. Now it's at $43, 65 to 43, and we know that where a lot of the damage was done, and people think, I think for the most part, at least in that handful of banks, that some of that stuff is a bit ring fence contained. Guy, I'm just going to use that word. I know that you love using that when we're talking about the potential for financial crisis. And if you look at the XLF, sold off about 20-some%. It's up a little bit from its recent lows here. And so on Friday morning, we're going to get JP Morgan, we're at Wells Fargo, Citi, BlackRock. And so it's interesting to me what expectations are right now. I know that people are hoping that they're going to hear a lot of sort of contained sort of commentary. And again, I don't think we're to learn too much. I think one of the fears that if you're like kind of bullish on the financial sector right here, what you don't want to hear are the idea of like cash return kind of being pulled back, that sort of thing, dividends and buybacks. And that would give us a sense that there's probably some trepidation about the not so distant future. Thoughts about these, because they're discounting a lot of bad news that we already know about, like, you know what I mean, as it relates to regionals. Are we likely to see something about some larger institutions, let's say X the BX, that's the Blackstone, but more in the money center and the lending space? And obviously, we've seen the housing market cool off a great deal. So in residential. So these are all things that I think are going to be like top of mind for most investors this
So
Friday.
many things to talk about there. I mean, you've mentioned correctly, you've brought up insurance companies. They've obviously, so many of them, I don't want to say have fallen off a cliff, but a lot of these stocks were trading on or around all-time highs. A lot of them have had pretty precipitous drops over the last few weeks. I don't think that's coincidental. Obviously, I don't think the Charles Schwab story is necessarily over, although the networks and the pundits seemingly have stopped talking about him for now. But it's not like that stock has gotten out of its own way. First Republic still trades terribly, in a word. And XLF, I mean, that's the one. I think it's a poorly constructed ETF. For my money, I think it's 12% Berkshire Hathaway, I think 10% JP Morgan, MasterCard and Visa, both probably another 8% each. So obviously heavily weighted towards those names. With that said, Dan, and I think this is worth pointing out, if you want to play Carter Worth, if you go back in February of 2020, before the world sort of went spiraling out of control on the back of COVID, XLF topped out around 31-ish, let's just call it, and then fell off a cliff. So that was past resistance to the upside. Well, past resistance becomes support. And go back and look. This started in June of last year. We traded down to 31, bounced. Then again, we saw it in October of last year, traded down to 31 and bounced. Well, here we are. We're trading basically 31 and a half, 32. There's been no market bounce whatsoever over the last couple of weeks. And this, to me, could tell the tale. That with the KRE, throw the HYG in there, and you have a lot of things you want to be looking at. And in terms of banks, people will talk about banks being cheap on book value, on terms of price to earnings, all those things, and that's true. The problem, of course, in my opinion, is the environment that they find themselves in and will find themselves in for the foreseeable future. That's more regulation, tighter credit standards, less lending, I think worse net interest margin, all those things. I mean, it just does not lend itself for these stocks to go precipitously higher. So I think there's a real good chance that banks sort of roll over on the back of earnings, and we're going to have an entirely different conversation over the next couple of weeks as to what it means for the broader market.
Yeah, I think you have to be careful, especially careful here as an investor. Yes, banks have come down quite a bit for obvious reasons. And it's tempting to say that now they're a bargain, and this is a good entry point. And to Guy's point with where support is on the IYF. However, we're heading into earnings season. We know that banks are the first to report. I don't expect that the statements are going to be all that positive. And actually, I think the risk is probably more to the downside that we get even worse cautionary statements than we were expecting. So I think we're all expecting regional banks to say things that we already know, right? We already know the pressures that they're under, and maybe those stocks have seen the pain that they were going to see in the market. What I don't think we know exactly is what the big banks are going to say and what the ripple effect has been, or maybe how they're adjusting their business models and their plans for the rest of the year because of what transpired in March. And I would not be trading banks. I would not be trading financials ahead of earnings. I think if you do see them fall off a cliff after earnings season is over, but I mean after the whole season is over, not just after banks are done reporting, then we can talk about some of the entry points, but I would wait this out.
Yeah, so a couple things here, Guy. You mentioned First Republic, and this was one that obviously a lot of investors have been focused on since the Silicon Valley Bank collapsed. The stock was trading $145 in early February, and it's trading just below $14 right now, and it's kind of flatlined at this like kind of $13.70 level. The headline over the weekend, I think it was, as Danny Moses would call, a Friday night dirty. First Republic slides after suspending their preferred stock dividend. Okay, so this is really the buyback and the dividend thing. This is one of the things. If we start to see the major money centers kind of raise their reserves and they kind of maybe hint to the potential for, kind of lessening buybacks, that would be the thing. I'll just say this about the banks. Jamie Dimon's annual letter was out last week. We talked about it a bit. It seemed fairly well balanced, especially for a guy who I think, 9-10 months ago was calling for an economic hurricane. Maybe that's some of what we've seen for some of these regionals and what they're dealing with. But listen, is it a tough trade into the print? Yes. From a trading perspective, I think Liz is the way you're thinking about it, is like be cautious. And if they get creamed for no good reason, maybe there's some like unusually good values there. I would say if they run up into Friday and they're kind of trying to find a little bit of a bottom, if you were just to kind of look at the XLF right here, then I think as a trader, I would put them out. I am actually long some puts, actually weekly puts. This is a very binary trade, and it's not something I would recommend to most people, but this is kind of how I trade. I want a little bit of exposure. I've been trading the XLF to the short side. To Guy's point, it's not a great constructed ETF, and I may look to kind of express that view. When you think about Visa and MasterCard, and then obviously Berkshire as maybe 20 or so percent, you know what I mean, or actually 23%, not a great way to play bank weakness. So I may kind of roll that into the BKX. All right, let's talk about some stuff in tech, because Liz, you just mentioned the underperformance today on the Monday, right? Yields are ticking up a little bit, and we know that some of these kind of higher valuation tech stocks are not liking that so much. But in the last week, we've had Samsung and Taiwan Semi miss their sales guidance, talking about some production cuts in the memory space here. We're seeing Micron up 7% today, really digging that. Western Digital really digging that. So production cuts might mean upward pressure on pricing. Guy, talk to me a little bit about this, because the backdrop of all this is that there's a report from IDC, which tracks PC shipments, showing that Apple's in Q1 were down 40%. Obviously, these are huge end markets for memory, right? So you're seeing this kind of thread throughout the PC supply chain. Might we see it in the smartphone supply chain? And we also have the fact that Apple, Microsoft, Google, Amazon, NVIDIA, all of these guys kind of related here in the mega cap tech trade. They've been keeping this market elevated, and we've been highlighting the concentration of those largest names here. So as we're recording right now, we have the NASDAQ 100 down 1.3%, the S&P down about 55 basis points. So we're seeing underperformance from the NASDAQ.
It's amazing how, that news for Apple, in my opinion, or those whatever you want to call it. I mean, the stock's only down 2.5%, maybe 2.75% today. I mean, that's having the stock rally from that 125 or so low, I want to say in early January, to just short, Dan, I think of about 168. So it's not like it's cascading lower on the back of this. But if you start to think about it, I mean, why should Apple be impervious to all what's going on in the world? I mean, they shouldn't be, right? I mean, they make expensive products that people need to buy. Now, people talk about their install base and their move into medical and all these different things that can move the needle. I totally get it, but I think they've been rewarded for that in terms of valuation. So I don't know why the market seems to be, at least, discounting it to a certain extent. The Taiwan Semi stuff, again, not insignificant. You talk about it all the time. I think you can make an argument that Taiwan Semi is one of the 10 most important companies in the world, and you start to see some of the commentary out of them. By the way, a stock that had a nice bounce off the bottom when they basically gave a tepid, if not miserable quarter, I want to say 6 or so months ago, maybe a little bit less than that. They talked about weakness in the first half of 2023, but they were going to make it up in the back half. And I remember saying on Fast Money and probably Market Call as well, I said they're buying themselves some time. They're probably buying themselves until about May, June. Well, it's off by about a month or so. But the fact that they think they have clarity in an environment where nobody has clarity, I think is completely ludicrous if you think about it. And now you're starting to see that. So that second half guidance that they gave probably has to come into question. And when you're talking about, again, a company of that much importance, you can't just say, well, it's Taiwan semi-specific. I think it's more than that, Dan.
All right, so Liz, you're a strategist, and you have a slightly different role as, let's say, some of your peers at big investment banks, right? They speak to kind of different constituents in a way. How much time do you spend focused on geopolitical headlines? Because this is tying into, like, over the weekend, there's Chinese that are running drills, around Taiwan for a potential blockade. We're sending ships out there, they're getting really close to, Japan and this. I mean, when you think about Taiwan Semi, you think about all of this kind of investment by U.S. multinationals, predominantly in the technology sector, and how they've kind of created their supply chains and the reliance on manufacturing and the reason, and then you throw in, like some of the efforts that our government is making about banning exports of advanced technology, right, to chip manufacturers. Like when you think about Taiwan Semi, and Guy just said it's probably one of the most 10 important companies in the planet, no doubt about it, man. I mean, if there is some sort of dust up with Taiwan between China and Macron from France, supposedly one of our closest allies, is over there sipping tea with President Xi, and doubting a little bit like our leadership in the world. I got to tell you, if you thought Russia's invasion of Ukraine and the disruption to the energy complex and natural gas and the like was a big deal for the global economy last year, just wait what a Chinese blockade of Taiwan would do for global supply chains, access to chips, and really just kind of like a further acceleration of this bipolar world that we are in with China. I mean, that could be devastating. I'm just curious, do you start to think about some of this stuff, and does it make you, I guess, less optimistic about the near term and the higher probability of a global recession if there is some sort of dust up between China and Taiwan?
Okay, so first of all,
usually you say a lot there.
Yeah, well, Guy used that one in your last question. That was,
am I
that
asking?
was 5
guys,
minutes long.
Put it. Really?
No, I'm kidding.
Well, so I mean, listen, if you have some comments, put it in the in the suggestion box here. If Dan's asking too long a question,
no, it's great. I'm just trying to figure.
Me and EY, or is that?
No, that's to the listener here.
Do we have a suggestion box?
I don't know. Just email Amanda.
Somebody
Amanda at
DM'd me a
riskreversal.com.
Okay, wait, but I want to cover this because I do have a lot to say about it. So last Monday, I was on a program called Halftime Report on CNBC. We do final trades. My final trade was to sell semiconductors.
Whoa.
And that was a very much macro call. The statements that I'm about to make now are macro calls. Obviously, there's unique things going on in certain companies, but the reason I made that call then was because obviously semiconductors have enjoyed this run up with tech, maybe even more so than many of the other industry groups. I think that run up was largely rate driven. As rates came down, you saw things like semiconductors rise in the opposite direction. And semis are the cyclical component of tech. I believe that if we do confirm that the economy is in fact slowing, headed towards a recession, cyclicals are going to get hit harder than tech in general. However, semis being the cyclical component of tech, I think probably take it on the chin pretty hard. So that was the trade from last Monday to sell semiconductors ahead of earnings season starting. That said, you're correct that my audience is different than a lot of the larger banks. They, have some institutional clients mixed in there, but they also do have some individual clients that they speak to. Mine is all individual clients and individual clients that largely are not working with a financial advisor, right? So the idea there is, yes, I think about it. Of course, I think about it very frequently. rather than necessarily taking a stance geopolitically on what I think should not, or anything political about it, it's more about helping the individual investor understand how it all affects the market, right? Because I think it's easy as an investor sitting in the United States to think, oh, semiconductors, phones, whatever, all the things that we're familiar with, and have a view about it from a U.S. consumer perspective, but not entirely understand how the supply chain works through, how China can affect everything that happens here, and the fact that we haven't necessarily seen that occur yet. It's been sort of threatened, and it's been maybe something that we think about on the periphery, but it hasn't actually happened yet and stopped the supply of what we use. So it's the education of how that could affect not only prices in the market, but the availability of what's in your hand on a daily basis.
Kyle Bass on Twitter. And if you don't follow Kyle Bass, you should. Forget about any ancillary political stuff. I mean, the guy is locked in, and he's probably as well versed on China as anyone out there. His tweet, I want to say earlier today or maybe yesterday, so I apologize. Doesn't matter. It's timeless in terms of what we're doing here. With Xi and the Communist Party of China effectively blockading the Taiwan Strait for the last 48 hours, deposits are flying out of the Hong Kong dollar and the Hong Kong banking system at large. Hong Kong dollar looks to have traded through the 40-year-old peg of 785 yet again. Geopolitics and rate differentials can't be much worse for those looking for stability in an unstable middling kingdom. Buckle up, his words, not mine. So that's out there. And then, we talk about this all the time, and I don't think there's a high probability of this happening, but there is an absolute probability of this happening, somewhere between 15 and 20%. If China were to do something in terms of escalating this aggression, what is Apple going to do? Because Apple pulled out of Russia. That wasn't a big deal for them. McDonald's did it as well. Starbucks did it because it didn't move the needle and they needed to do it. But if the same type of situation were to happen between China and Hong Kong, that almost forces their hand, giving the precedent that they set. So ask yourself then how the market's going to react to that. And if you don't think that's out there, you're just putting your head in the sand or not paying attention.
Well, you know what? The irony is Tim Cook was just over there. Tim Cook, and I said this on Fast Money the other night, and I got a lot of hate mail about it. I said history is not going to look too favorably, I think, on people like Tim Cook and Elon Musk, for that matter, who, Tim Cook, a social warrior here in the U.S., but really does everything in his power not to address this totalitarian regime in China, probably the most totalitarian regime on our planet, and how the workers are treated at the factories that make our iPhones and all that sort of stuff. And he's been very mum about, the treatment of the Uyghurs. This is an ethnic group that is very clearly persecuted over there. And then you have Elon Musk, again, who is this free speech warrior. He bought Twitter in the name of free speech, supposedly. I think he's a massive hypocrite. And he's over there cozying up to the Chinese because he needs their consumer demand. He needs their manufacturing. He needs access to the rare earth materials. And most of their expected future growth is expected to come from China. So this is a huge issue. And I want to go back to Kyle Bass's Twitter guy. I don't know if you saw this. This is a tweet from April 6th, okay? And Kyle Bass tweeted, in an interesting twist of potential censorship, Twitter would not allow this tweet to be sent after several attempts. So here's a photo of it in my drafts. And here is what the tweet was. This is exactly how China plans to ratchet up against Taiwan. Taiwan is only about 14 days of its energy needs and storage. And so basically he's talking about the potential for a blockade. And he's saying, Kyle Bass, that Twitter would not allow him to tweet this in the U.S. So when you talk about censorship, you talk about Elon Musk, he's a massive freaking hypocrite, okay, because he bought this thing supposedly in the name of free speech, okay? But he can't, on his platform, have too much of this stuff going out there because he's heading over to Shanghai to announce a new gigafactory, and he needs to cozy up to the Chinese. So again, massive hypocrite. You can tell me I'm wrong. I'm just fucking not, okay, here on this one. All right, and then the last one I just want to say is that for all these people and all the hate that we get, Danny, Guy, and myself, less so Guy, because I think Guy is fair and balanced when it comes to the Tesla here.
You know what's interesting when you say that would be a great tagline for like a business network,
like a news
network.
network or something that's basically not fair and
Fair and
balanced. Yeah, that
balanced.
makes sense. But when you think about Tesla, they just
Right.
announced. I think Danny would also call this a Friday night dirty over the weekend. They just cut prices again on
The
almost
fourth
every.
time this year,
I mean, like,
right?
yeah. So when you think about what's going on with Tesla here, we talked about the margins. Last year 25.6% gross margin, expected to be 22% this year with all these price cuts. I would suspect, and even after those Q1 deliveries, which were up 4% quarter over quarter, this is not going to be pretty. Whatever they report, guys, I mean, you guys have at it, okay? Be excited about it. Margins, I think Morgan Stanley was out, guy, talking about margins. They'd be lucky to do 20% this year. If this was a margin story in a declining, more competitive environment, I just don't see it, man.
Yeah.
So to me, I'm still, short of the thing. I think we're going to fill in that gap from January. It was their earnings gap back towards 150. And then who knows? Like, all bets are off, because if we have a global recession this year, think about the demand for these sorts of vehicles at the price point that they are. They can't lower prices fast enough to kind of compete with all of these guys. So thoughts there, guy?
A lot to take in there. That's the third time we've said it now.
Well, listen,
I'm
just
not
so
an
you know, I want to
apologist
be
for
really
Tesla.
clear about this. For all of you people who think that like, this is not a Q&A, this is not being concise about your question. This is a conversation.
Yeah.
So I'm kind of getting my
You're
2
turned
cents
up.
out, and then I'm ending it with some questions here. So it's not like I'm just like limited to like 30-second questions here. Isn't that the way this thing works here, guy?
Yeah. Did
your
we say
podcast.
otherwise? All I said
No.
was this.
Well, it seems like there's this growing tension about the length of my questions on
No, I'm
Mondays.
not tense. So I
not-
enjoy it.
I'm quite relaxed.
I'm extraordinarily relaxed. So, as I said, I'm not a Tesla apologist, but I will tell you, I think it was in the fall of last year that they said margins are going to start to come down. And they mentioned that the legacy OEMs, the Fords and the GMs, I think their margins are about 16% or so. And what they said was, look, we don't think it's going to get that low, but we're going to start to drift down to those levels. So I think to a certain extent, at least this should be expected, but it doesn't make it good. And 4 price cuts in a year that we've just made it to April, is not particularly good. I can do that math over the course of the year, how many that would be. On top of which, the stock did trade down to 165. The bounce was pretty significant, but we failed to get up to the levels that we topped out earlier this year, which I think was 218. So now you have at least a series of lower highs. Let's put it out there. And no, the stock does not trade particularly well. And no, they're not immune to all of this. And one has to wonder what the market will do if, in fact, something happens between China and Taiwan, Dan.
Also, forgive me for stating the obvious here, but for anybody listening who hears 4 price cuts in a year, or hears things like home prices are down, or whatever the price cutting that's going on, and thinks to themselves, well, that's good, because if inflation is the problem, that brings down inflation. Well, why are they cutting prices? Why are home prices coming down? Because there aren't buyers that are willing to pay it. And yes, that brings inflation down, but a thing that is out there to be purchased is only worth as much as somebody's willing to pay for it. And if they're not willing to pay more for it, that means that the consumer that we've all kind of hung our hat on as being so strong and spendy and buying whatever it is, no matter what the price increases are, that means it's slowing down, and the demand just isn't there.
Well, and to tie this whole last bit together, because we started talking about semiconductors and the potential geopolitical impacts of not just, some sort of dust up with Taiwan, but also just the ban of our advanced chips and that sort of thing. Think back to all the issues that we had with consumer electronics during the pandemic because fabs were shut down. There wasn't enough chips being made, right? And so then you think about what happened there. You could drive around and you could go look at like car lots, right? Like, and they just didn't have any inventory. Drive around right now, they are full with inventory at a time where it's much more expensive to get a loan to buy a new car. All right. So like when you think about, some of these higher priced EVs, like it just doesn't make a lot of sense to me. And then if you go back to semis, and if we ever had some sort of issue with supply of semis, we could be right back in the situation where you see all this double ordering for semis, and it's going to be harder to track. But again, to your point about these being very cyclical in nature, that's one of the reasons why I think the semiconductor index right here is a good short, like your halftime report, final trade. I'm sure you showed up all the SDs on the IC that day with that final call. Wouldn't you say so there, guy?
My view on that fine program. noon Eastern time.
I love the program. I love Scott Wapner. I love what he does with it there. All right, so
Can
guys,
we talk about what's happening this week? There's a lot happening this week.
okay, so we
What's
have
to
a
look
few
at?
minutes left. So we have CPI. So Liz,
Yeah.
We're all in agreement that backward-looking jobs report not going to be that impactful, despite the fact that the CME Fed Funds tracker for the May meeting is got ticking up, right? Since then, CPI, how important is it going to be a tradable event, or is it going to be a market-moving event?
I think it definitely could be a tradable event. It happens on the 12th. That happens on Wednesday. So that's really kind of before earnings season kicks into high gear. We also get PPI this week, and we get retail sales. So we're going to get a lot of reads on the consumer, what's affecting the consumer, how the consumer has behaved. And then we're getting PPI, which is basically businesses and what they're paying in order to produce their stuff. We're also going to get capacity utilization. There's a lot of data coming in this week. That's a good read on the economy. It's a good read on the consumer. And it's right in the front of when we start to hear Q1 earnings. And I said also on halftime last Monday, besides the short semi trade, I thought last week would be kind of a quiet week in the market. It wasn't as quiet as I expected, but I did expect this week to be volatile because of all the data that's coming in, because of earnings, and just because I think we had this like calm before the storm of this expected wave of information.
I don't know who this Cliff guy is. We used to get his notes back in high school. I'm sure he was brilliant. But I'll give you the Cliff Notes version of this week because EY knows this far better than I. But I have posited that CPI, again, my opinion, is linked to inflation. PPI is linked to the economy. So you could actually see CPI rise and it be a bad thing vis-a-vis inflation, and PPI go down and actually be a bad thing because it's linked to the economy. So do not, just my opinion, if you see a weak or soft PPI, do not equate that with somehow the Fed's job is over or whatever. It's just the normal course of events. The economy can slow, prices can continue to go higher, and that ain't a good recipe, Dan Nathan. That's something that I call a witch's brew, and Danny Moses calls stagflation, I believe.
Yeah. All right. Well, we covered a lot of ground here. So the data is going to be important. We also have the Fed minutes on Wednesday, and then we have the bank earnings on Friday. My take there, any rally into that, I think you want to sell them. I think they will make new lows in Q2, but I don't think it's a great press right here, right now. And then the other thing is we can all agree that Elon Musk is a massive hypocrite. That's one thing. I just want to say this because I just went to his Twitter that he tried to rename Titter over the weekend. Did you see this thing? I mean, like literally, this is what this guy is engaged in doing. And then the other thing is he just changed his name. His handle to his 134 million followers is still at Elon Musk, but he changed his name to Harry Bolz. How would you pronounce an O with like a line over it? Because Bolz. Okay, so his new name on Twitter is Harry Bolz, I think is how you would pronounce it. So hypocrite and really bad sense of humor, and especially for a guy like me. Remember last week, guy, on April Fool's, I played a little joke, in my Twitter account, and they just shut it down. So, you know what? Have at it, dude. I'm going to be honest with you. This thing with him, going to kind of end in tears, but it is what it is. We're going to have to wait a little bit. All right, Liz Young, EY from SoFi, thank you for joining us. Liz will be on Market Call with Guy tomorrow at 1 p.m. Eastern.
That's right.
Then she will be back with Guy and me on Thursday at 1 p.m. Eastern on Market Call. Oh, look at that. And you know who else is on Thursday, Guy? What we just call him hashtag what? Hashtag
Butters.
what? Butters. We
Not
have
even a
John
hashtag.
Butters.
He doesn't even need a frickin' hashtag.
Well, no, but
Just-
he
it's
doesn't
just
have
Butters.
a Twitter
The
account. So he's-
Pavlovian response we get in the comments to him,
Yeah,
it's
Butters.
amazing.
Yeah, so Butters is on Thursday.
He's
Wednesday.
probably Russian, like a scientist.
Butters is on Wednesday.
Oh, thank you. Butters is on Wednesday, so he's not.
Doesn't matter. It's still Butters.
But just tune it. Listen, go to the Reversal Media YouTube site. Watch Market Call.
Watch it all.
At 1 p.m. Eastern. And another thing, we put our first on the tape. This is going to be on our Reversal Media YouTube page, but we put with Mike Wilson. He's a CIO and head strategist at Morgan Stanley. That dropped on Friday. It's in the YouTube store if you prefer to watch the video, or you can listen to it in your favorite podcast store. Guy Adami, thanks a lot. Check us out on Market Call. Check Liz out twice this week. Oh, jeez.
Wait a second. You going to be on the? you going to be part of the IC on the on
No,
the,
not
on
this
the
week.
H-
No, I
on
will
the
be on
HR? No?
the closing bell program.
Oh, nice. I love that.
Yeah.
Okay, we'll tune in.
All right. Thanks, everybody, for joining us on a Monday. Hopefully, you guys, we didn't offend too much. Did we offend too much? Maybe just me on the Harry Bowles thing. That's him. That's not me.
I'm
It's
no
just him.
comment
No,
on
no
that.
comment.
Yeah.
Okay. All right. Thanks for joining us. We'll see you later this week. Bye. I mean, he literally did that. Look at his
he's so
fucking Twitter.